Africa's infrastructure needs remain vast, with estimated funding of as much as $170 million required to meet it per annum. For greater perspective on this, Bronwyn sat down with Keval Bid, regional representative for FMO at Standard Bank's Financing Africa Forward Summit, and asked him how FMO facilitates sovereign funding in the context of Africa.
So I think as FMO, our mandate is really focusing on emerging markets and private sector. And where we like to play is actually building the markets and also building long-term sustainable development of businesses, but along with the communities that they operate in, work with. So we have a model of what we call pioneer, develop, scale. And what we look at is, especially there are in many markets where they're unbankable projects, so we try and see how do we make these unbankable projects into bankable projects. So we call it market creation, where we provide like an ecosystem led initiative to help businesses build by also tackling not just specific business issues, but also looking at market issues and also advocacy at a national policy level using partners, right? So that's the first piece. Once these are more bankable, we use blended finance. So that's typically funds that we get from either governments or philanthropic money, and we blend that with our own funding for very high-risk projects, and which have very high development impact. So we call that using public funding for development finance purposes to de-risk projects. And one of the things we do is, especially working with commercial banks on the continent, they're a great intermediary to actually reach out to MSMEs or people who don't necessarily get access to finance, like women, youth, marginalized communities. So we provide them with guarantee instruments to help them de-risk, to enable access to finance to these groups. And often what we're trying to also really push for is to move away from collateral-based lending, which is very prevalent, to more cash flow-based lending, by de-risking lending to these segments, right? Once we see stability and we can scale up these solutions, we tend to use our own funds to scale up these investments. We also tend to mobilize third-party funds, especially pension funds, family offices, philanthropic money again, to crowd in to scale up further private sector investments, right? So we've got a very different lens to investments across the different stages. One of the other things we also really pay keen attention to is especially environmental, social, and governance aspects, to make sure it's an inclusive way of funding projects and investments in markets, right?
You highlight de-risking there, and it's so crucial that you mention that, because that's exactly how we ensure that capital is fair, correct?
Correct, exactly.
And especially on a continent where you talk about, moving away from collateral-based lending, that even more crucial, because in Africa, do you find that that's just really not something that works? That's something perhaps taken from the global north, impacted here in Africa in terms of how we view lending, but it really doesn't actually serve the continent and the population base that's here.
You're right, and there are many reasons for it, right? And there are far too many reasons to solve all those problems. But I think what we can do is allow for the banks or intermediaries to be able to test out new models, right? And we're working with the banks to essentially say, if you look at sub-Saharan Africa, most of the GDPs or economic activities largely coming from agri, right? So you have a lot of smallholder farmers, a lot of MSMEs working in the value chain, right, who typically don't have access to finance. A lot of these farmers don't have actually even the land titles that they operate on, right? It is a big challenge. Doesn't mean they're actually riskier than a larger kind of player, right? Some of the data that we've seen working with the different banks, the non-performing loans levels is actually far lower than segments where you think would be actually safer, right? But what we're trying to do is, how do we increase lending? How do we allow these smaller farmers to access? But we're also looking at what are the lending practices, right? Can you make that easier, right? Less predatory, easier.
Less red tape.
Yeah, exactly. And also, once you have this perceived risk taken away and banks are able to see that this lending model actually works, they're also able to lower the rates then, right, from a risk premium point of view.
Yeah.
Also speaking to the fact that we really do see these small and micro businesses as growth drivers on the continent, and the more we can support them, it means that the economy of this continent really moving forward in a way that it needs to, right?
Correct. So two things there. So it's private sector expansion, right, at all levels, right? And more importantly, you have human capital expansion. And when you have human capital expansion, it's societies and the communities that benefit, right? And that can drive more value addition that we talk about that's needed on the continent, right? But that's why private sector expansion is needed, human capital expansion is needed.
That was FMO's regional representative, Keval Bid.